Hello and welcome to another Finax podcast. My name is Tamara and this is my guest, Toni Vitali, Croatian blogger and vlogger. Toni, hi.
Hi, Tamara, and thanks for inviting me again.
It's nice to have you here. Today, our topic will be a classic one. We are going to discuss differences between passive and active investing. It's something that I know you like a lot, and I think we've been talking about it in quite a few webinars and podcasts in different ways. But today, let's just talk about the main differences and points between these two types of investing.
Yeah, sure. As you mentioned, it's one of my favorite topics. I get really passionate talking about it, which is maybe funny to some other people. But yeah, being a financial geek, I guess that makes sense. But yeah, long story short, maybe there isn't a straightforward line between active and passive investing. But let's just say that active investing is focused more on the price. Usually it's focused more on the short term. Usually people invest a lot more money and energy in active investing, and usually they make moves or trades, whether it be buying or selling some investments on a fairly shorter time period. So some active investors invest every day, multiple times. Some invest a couple times a week or a month. And on the other hand, the passive investing is more investing for the long term in general, with much less effort, much less time and energy that's invested in it. And usually we choose some investments that are widely diversified, that are very, very simple, and we just follow a predetermined plan, usually for a longer time period.
Yes, I like to always mention the strategy difference, right? The main thing in active investing is buying and selling. So as you said, it's really price related, and we are trying to pick the winners and make better performances on our decisions or our picking. And in passive investing, the strategy is buy and hold. As you said, it's long term, and this is I would say, actually real type of investing, because if you really want to invest and build your wealth, you need to do it in the long run.
Yeah, sure. As we said, active investing is more focused on the price, and the passive investing, I would say, is more focused on the value. So when we are investing passively, we don't care that much what is the price today or what is the price going to be next week or next month. And we don't panic maybe when the price dips, because we know it's a normal thing. But we are focused on the value. We are focused that we are buying shares in some of the biggest companies in the world, or in a lot of different bonds or other asset classes. We just focused on the value that we are getting for our money, more than the current price that the market values the investments we have at a certain point.
As you mentioned, also passive investing is all about diversification, right? And also, as you mentioned, sometimes the markets fall. And when we have a well-diversified portfolio, it doesn't hurt us as much.
Yeah, exactly. I would say diversification is one of the biggest differences between active and passive investing, and one of the biggest reasons why usually, statistically, passive investing is superior for most people. So diversification, simply put, is just a concept that tells us that we should diversify risk by investing in a large number of different investments. So, for example, if we only invest in one investment or 10 investments, it hurts us way more if that investment goes to zero or if it falls significantly. But if we invest in hundreds or even thousands of different investments, which is very easy to do today with some passive funds, then we really spread out the risk as much as we can. So not a single investment that significantly falls impacts our total portfolio significantly.
Okay, next are fees.
Yeah, fees are also a huge factor when we're talking about the differences between active and passive investing. If we're talking about active investing as solo investors, as investors that pick our own stocks or bonds or whatever, then we should think about the transaction fees. So, for instance, whenever we buy or sell a security, we could pay a fee to our broker, or there are some additional fees for various things we do while active investing. While on the other hand, passive investing usually incurs a lot less fees. So usually we only have the fee of our fund, which is very, very low. If we compare it maybe to investing through actively managed funds, usually depends on the fund, but let's say the average today is around 2% per year for actively managed funds. And for the passively managed funds is around 0.2% per year, so around 10 times less. So as we like to say, that fees are the only thing in investing that's 100% certain. We're going to pay the fees no matter what. So we may just as well try to minimize the fees as much as we can. And passive investing is surely the easiest way to do it.
While we talk about fees, I think it's also really important to mention compound interest and what it means when it comes to fees.
Yeah, I mean, probably the most important fees are the fees that are recurring, that are being paid year after year after year. And we talked about the difference between passively managed and actively managed funds. With actively managed funds, that 2% that we mentioned maybe doesn't seem like much, but that's 2% of our total value every single year. So no matter if the fund does well or does poorly that year, we're gonna pay that fee. So for example, if we expect maybe 6% growth of our fund and we pay 2% per year, that's 1/3 of the total profit that we expect that we're going to get, that goes straight to the fees. And that difference is bigger and bigger as we go through the year. So if you use some compound interest calculator and maybe put a sum that you're willing to invest maybe every single month, and put maybe a time period of 10, 15, 20 years and so forth, if you change the returns from 4% to 6%, you're going to see it's a huge difference. So people are not aware what does 2% per year mean on a very long term. So it's not intuitive, but if we use these calculators, we can get a pretty good image of actually how much are we going to miss out in terms of returns if we pay high fees year after year after year.
Yeah, just think about loans and compound interest when you have to pay loans. So you can reverse it in a way and see also how much you can actually earn if you use compound interest and if you reinvest everything that basically you have earned yearly. Okay, well, when we talk about fees, we also have to mention something that nobody likes to pay, and that's a tax.
Yeah, taxes are also very, very important in investing. And obviously, it depends on the country of your residency, how much investing tax are you going to pay. But generally, most countries have some fees that are not suitable for active investing. So there is often a dividend tax. And if we use passively managed funds like accumulating ETFs, we can accumulate the dividend that we get from stocks in that fund. So we don't pay the dividend tax. Also, some countries have a more favorable tax system for long-term investing than short-term investing. So that's also a big benefit in terms of passive investing when we talk about the tax differences between the two.
You have mentioned that obviously statistics show us that passive investing beats active investing around 90% out of the time when it comes to 10 years and longer periods. Let's talk about the reasons why it's like that.
Mm-hmm. Yeah, sure. I mean, there are companies that do comparisons between actively and passively managed funds. And as you said, around 90% of active funds don't beat passive funds on those little bit longer time periods. So 10, 15 and more years. Why is it? It's the things that we mentioned already. I think the fees are the biggest one. As you said, the fees are getting charged no matter what, no matter if the fund is doing well or not. The second thing is diversification. So, for example, some actively managed funds, maybe they don't they probably don't invest in hundreds or thousands of different investments, but they invest maybe in a handful or a couple dozen investments. So if one of them falls significantly, that impacts the returns of the fund. So we go back again to diversification. Also, for us personally, we have to take as we said, the tax reasons as well. But also, people don't understand that it's very, very difficult to pick winning stocks or some other types of investments in the market. So, according to some research, around 94% of stocks in the U.S. market combined had a total return of 0. So the rest 6% of the stocks in the market were responsible for the whole return. So the question is, are we able to guess consistently those 6% of stocks year after year after year?
I think the statistics prove us that we are not able. Even the professional managed funds cannot basically as we say, win over the market, and they cannot perform better than market on long term. So as much as some of the professional active managers are trying to do so, it is really, really hard.
Yeah, exactly. People don't realize how hard it is, especially today, because it's so easy to pick different stocks, to buy different stocks through simple platforms. But yeah, these are some of the main reasons why passive investing usually beats active investing. But I would say maybe some non-financial reasons, such as the influence of emotions on investing, are probably as important, if not more. So if we are actively investing, we are probably way more influenced by emotions. If we constantly check, okay, what is the price of my investment? And if we are influenced by either fear of losing money or greed, that we're trying to make more money in the short term on some very high risk investments, those are usually the emotions that are not favorable to our bottom line. So I would say the emotions here are a big factor, but also the sheer time and energy investment that we're making in the active investment world. I don't personally think it's worth it. Even if I would get slightly better returns, I would still probably not spend half of my time looking at 4 different computer screens and trying to find a winning investment. For me personally, I would like to spend that time more with family or going outside. And the statistics show that while doing that, while taking a passive approach, I actually have better results than maybe people who are spending a lot time and energy on active investing.
Yes, definitely. I think that's one of the reasons that is often overlooked and people don't think about it. But definitely, time is the one resource that is unfortunately limited for all of us, and we should kind of think about how we want to use it at its best, at its fullest. So it depends on I think individual preference, but I think that most of the people could probably spend their time more wisely than looking into computers and trying to follow all the possible news and statistics. So as you mentioned as well, emotions, there is a whole part of economy called behavioral economics, which is talking exactly about this. And we know also for the fact that even the clients who are checking their portfolios more often just to see how they are doing are more inclined to make mistakes and to make some strategy changes than those who literally invest and forget about it and go on about doing their own business and living their lives.
Yeah, it's maybe counterintuitive when we hear it for the first time, but unlike many other areas of life in which if you invest a lot more time and energy, you usually get better results. But in investing, it's actually the opposite. So the more passive an investor is, usually the better result they get. So for me, like there's so many different reasons that we talked about today why passive investing is a superior choice, I would say, for basically all non-professionals. Probably most even professionals that active investing, I don't think is just a feasible path for most people.
Just one thing I think is worth mentioning as well is rebalancing and the whole, I'd say, science about it and around it. Just maybe if we can, in a couple of sentences, explain to people who are not maybe familiar with the term and what it actually means.
Sure. I mean, when we are making our investment plan, usually we want to allocate a certain percentage of our total investments to a certain asset class. So if we are talking about stocks and bonds, which are the most common ones in financial investing world, let's say that we decided that we're going to have 60% in stocks and 40% in bonds. But over time, that ratio is, of course, going to change how the prices change. So usually the stocks have higher returns, but also higher risk. But let's just say that our portfolio went up from 60-40 to 65-35 or to 70-30. And there's a bigger gap between the two. And maybe that's not in line with our risk profile. So we are taking a little bit more risk than we would like to. Then we have to rebalance. So we have to either buy more bonds for our portfolio to go back to 60-40, or we can sell some stocks and buy some bonds and do the same. So we want to keep that allocation fairly stable through time, because it has been shown that it impacts the return to risk ratio in a favorable way. So how do we go about doing it? If we are investing by ourselves, it's could be a little bit tough. So we have to keep track of the valuations. We have to keep track, okay, what am I supposed to buy? What am I supposed to sell? We have to keep track of the tax aspect of it. So maybe some of these events are taxable, so we have to take that into account. So one of the solutions for rebalancing is to automate it. So there are platforms like Finax that can automate that process for you. They can keep the allocation inside the lines that we set up at the very beginning.
Yes, and make sure that, if possible, according to the local tax laws, you don't actually pay tax because of the rebalancing. Toni, thank you so much for another great podcast and for going through this interesting topic with me today. Looking forward for the next one, and hoping that we have helped somebody today to learn a little bit more on investing and maybe even how to personally go about it.
I really hope as well, and thank you for inviting me, Tamara, and see you another time.
Thank you. Bye.